Dear students, welcome to my channel. In this video, I will be sharing 12th Accountancy book inside one words. Those who have not subscribed my channel yet, subscribe. And if this video is useful, kindly share with your friends. In this video, I have covered only the book inside one words. In the upcoming videos, I will be sharing a student activity given in each lesson and also case study given at the end of each lesson. And I will be giving this PDF link also, so that you can by using that link you can take printout of these questions. Now chapter 1, accounts from incomplete records. The companies cannot keep books on single entry system because legal provisions. The difference between the total assets and total liabilities taken as capital. Under the net worth method, the basis for ascertaining the profit is the difference between the capital on two dates. The statement of affairs method is also called as net worth or capital comparison method. Dash is the statement showing the balances of assets, liabilities on a particular date is statement of affairs. Pick the odd one out, balance sheet. Adjusted, I'm sorry, pick the odd one out here, straight line method. Adjusted closing capital is closing capital plus drawings minus additional capital. Income and expenditure account is prepared following accrual basis. An advance receipt of subscription is from a member of the non-profit organization is considered as a liability. Which of the following is to be recorded in an income and expenditure account? Profit on sale of fixed asset. On what basis the receipts and payments account is prepared? On cash basis. Expenditures greater than income will be a deficit. In a non-profit organization, the sale of old newspaper is generally considered as revenue receipt. Rent paid in advance in non-profit organization is asset. The amount of or property received by non-profit organization as stated by the will of deceased person is commonly referred to as legacy. Some organization are established for the purpose of rendering services to the public without any profit motive. If the donation is received without any specific condition, then it is called general donation. Capital fund is also called as general or accumulated fund. Match it. Here sports equipment is billiards table. Investment, it will receive interest. Old sports material are balls, bats. Admission fee is paid at the time of admission. Next is again match. Subscription is a revenue receipt. Life membership is a capital receipt. Honorarium, a revenue expenditure. Purchase of furniture, capital expenditure. Dash items will be recorded in the balance sheet. In non-profit organization is capital items. Dash is the remuneration paid to a person who is not a regular employee of the organization, honorarium. Which one of the following is correctly matched? Traveling expenses, revenue payments. Which one of the following is not correctly matched? Interest received, revenue payment. Again match. Not for profit organization is income and expenditure and balance sheet. Schedule 3 of the Companies Act 2013 is under section 8 Companies Act 2013. Non-cash items, depreciation, outstanding expenses and accrual income, revenues, gains, liabilities, credit balances. Closing balance of partners current account may be debit or credit balance. Here the section is given, you have to correctly match the section. Remuneration to partner is section A. Profit sharing ratio is section B. Interest on capital is section 13C. Interest on loan is section 13D. Product method can be used in all situations as an alternative to direct method. Interest on capital is calculated on the opening capital. Current accounts for partners will be open under fixed capital method. The name under which the business of a firm is carried on is called firm name. Amount invested by partners in the partnership business is called partners' capital. The balance in the profit and loss appropriation account is transferred to the partner's capital in the profit sharing ratio. In dash method, in fact fixed capital method, the capital of the partners is not altered and remain generally fixed. All the transactions between the partner and the firm are recorded in the capital account in fluctuating method. In sole proprietorship, the profit and loss account is directly transferred to the sole proprietor's capital account. The rate of interest on capital is generally agreed by the partners and it is mentioned in the partnership deed. Under fixed capital method, salary payable to partner is recorded in current account. Profit and loss appropriation account is nominal in nature. Under fluctuating capital method, profit or loss in a year will be transferred to the respective capital account. The debit balance the debit balance of the current account will be shown in the asset side of the balance sheet. Here again match. Partnership agreement may be oral or written. Partnership Act is 1932. Maximum number 50. Registration of partnership is optional. If a firm maintains both capital and current account of the partners, additional capital introduced will be recorded in capital account. Partners are entitled to remuneration only if there is a profit in the firm. If the partners are entitled to interest on loan or advance at the rate agreed by them if there is a partnership agreement. If there is no partnership agreement, the partners are entitled to receive interest on loan at the rate of 6% per annum. According to which section in Partnership Act 1932 provides interest on loan advanced by partners at the rate of 6% is section 13 subsection D. Interest on partners loan is a charge against the profit. Whether there is a profit or loss of the firm, this interest is to be provided. Interest on partners loan is a charge against profit. Hence, interest on partners loan is transferred to profit and loss account, not in profit and loss appropriation. It should be transferred to profit and loss account. The net profit as per profit and loss account of a firm is subject to the adjustment of interest on capital, interest on drawings, etc. by preparing profit and loss appropriation account. The balance in the profit and loss appropriation account is to be divided among the partners according to the profit sharing ratio. In the absence of profit sharing ratio, the partner will divide in a equal ratio and it is transferred to capital or current account. In which type partnership, the liability of partner is limited to the extent of their capital contribution. Limited liability partnership. Limited liability partnership is formed as per the provisions of which act? The Limited Liability Partnership Act 2008. So the provisions of the Partnership Act 1932 will not be applied to limited LLP. Okay. In limited liability partnership, who can become a member? An individual or a body corporate can become a member. Next lesson, fourth lesson. Dash is the present value of firm's future excess earning, goodwill. Goodwill is shown under the fixed assets in the balance sheet. Goodwill enables the business to earn more profit compared to a new business. The monetary value of earning more profit is termed as goodwill. Goodwill has a definite value depending on the profitability of the business enterprise. Goodwill helps in earning more profits and attracts more customers. The profit earning capacity of the firm determines the value of its current assets. Goodwill can be purchased or sold only when the business is purchased or sold in full or part. Goodwill acquired by making payment in cash or kind is called acquired goodwill. Which goodwill can be recorded in the books of accounts and is shown on the asset side of the balance sheet under the fixed assets, acquired goodwill. The goodwill which is generated by a firm based on the features of the business such as favorable location, loyal customers, etc., that is termed as self-generated goodwill, and which goodwill cannot be recorded in the books of accounts, self-generated goodwill. The excess of purchase consideration over the value of net assets acquired is treated as acquired goodwill. Simple average profit is calculated by adding the adjusted profits of certain number of years by dividing the total number of such years. Capital employed, the formula is fixed assets plus current assets minus current liabilities. Annuity refers to a series of uniform cash flows at regular interval. Some information I took it from Do You Know Fact. So if you have any doubt, you can refer that. Goodwill based on capitalization of average profit method and capitalization of profit method. When you calculate by different these two methods, the amount will be same. Next, lesson 5. Determination of current values of assets and liabilities called revaluation of assets and liabilities. Revaluation account is called profit and loss adjustment account. If the market value of the investment is less than the book value, then the difference is to be subtracted from the investment fluctuation fund, and the balance of investment fluctuation fund is it will be transferred to old partners capital account in the old profit sharing ratio. Profits and losses of previous years which are not distributed to the partners are called accumulated profits and losses. New partner become liable for all the acts which are carried out by the firm from the date of his or her admission into the firm. In case of workman compensation fund, the excess amount after providing for anticipated claim, the remaining amount will be accumulated profit, that will be transferred. Okay. Next is a memorandum revaluation account is a temporary account, and it is opened when the revised values not to be shown in the books of accounts. Sometimes an existing partner may also gain in share of profit on admission of a partner. So in that time he has to compensate the sacrificing partners of his share in the total goodwill of the firm. To compensate the sacrifice made by the existing partner, goodwill brought by the new partner is distributed in the sacrificing ratio. Sacrificing ratio is calculated at the time of admission of a new partner. The difference between the old ratio and new ratio is sacrificing ratio. When goodwill is paid by the new partner to the old partners privately, then no entry is made in the books of partnership form. Next, retirement of a partner. The difference between the new ratio and old ratio, here it is gaining ratio. The retiring partner's share of goodwill is to be valued and adjusted through the capital accounts of the gaining partners. Next is company accounts. The maximum amount which can be raised as capital is authorized capital. The part of issued capital which had been applied for and also allotted by the company is known as subscribed capital. This capital represents that part of authorized capital which is offered for subscription, that is issued capital. It is a part of subscribed capital which has been called up by the company for payment. It is a called up capital. It is a part of called up capital which has been actually paid by the shareholders, that is paid up capital. Here this activity is also given in your textbook. The company's annual report consists of the following data. The face value of its shares is rupees 10 each. Identify the company's registered capital, issued capital, subscribed capital and called up capital. See here they have given you the subscribed capital. You have to match. I have given in the form of match. You can refer in the textbook company lesson, it is there. See, the highest capital will be the authorized capital. Now see here, authorized capital is 5 lakhs. Subscribed capital is 3 lakhs. Issued capital, next to the authorized capital, issued capital. Next to issued capital is subscribed capital. Then out of subscribed capital, how much money the company has called up, that is called up capital. So I have matched here. Issue of equity shares to the existing shareholders of the company through the letter of offer is known as right issue. Issue of equity shares to the existing shareholders of the company at free of cost out of the accumulated profit is bonus shares, bonus issue. Invitation to subscribe equity shares to a select group of persons by a company through issue of private placement letter. It is according to the section 42 of the Companies Act 2013. Next is, these all are given in the do you know fact. It is given in the box. You can refer if you have any doubt on regarding these questions. Issue of equity shares to the public through prospectus by a public company is called as public issue. As per SEBI guidelines, minimum application money shall not be less than 25% of the issue price. And as per the section 39 of Indian Companies Act 2013, application money must be at least 5% of the nominal value of shares. According to Table F, Schedule 1 of the Indian Companies Act 2013, period of dash, that is between two calls, how much time is 1 month period should be there. According to Table F, Schedule 1 of the Indian Companies Act 2013, the amount of one call should not be more than 25% of the face value of the share. The share capital may be received through installments. First installment is application money. Second is allotment money. Third installment first call. The last installment is a final call money. When a company issues shares at a price more than the face value, it is known as premium. When the number of shares subscribed is less than the number of shares offered, is under subscription. When applications are allotted in proportion of shares applied for, it is called pro rata allotment. If the minimum subscription stated in the prospectus is not received, all the application money received has to be refunded to the applicant. Dash is a demand by a company to the shareholder, that is called, okay, holding partly paid up share to pay further installment towards the purchase of price of shares. When the share capital is received through installment, first installment is called application money. The excess amount paid over the called up value of share is known as calls in advance. If the company, if they can refund, or if they decide to adjust, they have to open a separate account called calls in advance account. This calls in advance is not a part of company's share capital, and it will not receive any dividend. Calls in advance should be shown under the current liabilities in the balance sheet. As per the section 50 of the Companies Act 2030, a company can accept calls in advance only it is authorized by its articles of association. As per the table F of the Indian Companies Act, interest may be paid on calls in advance. If the articles provide so, then it should not exceed 12% per annum. And as per Table F of the Indian Companies Act 2013, interest may be charged on the calls in arrear if the articles of association is providing. It should not exceed 10%. Next is 8th chapter. Here everything is taken from the information given in the boxes. Okay, if you have doubt, you can refer that column in the 8th chapter. Indian Companies Act 2013, according to section 129 subsection 1, also states that financial statements shall be prepared in the form provided in Schedule 3 of Indian Companies Act. As per Schedule 3, these all are rounding off, so you can go through this. The turnover less than 100 crore rupees of the company may be round off as to the nearest 100,000, lakhs or millions or decimals thereof. Next is, as per the Schedule 3 of the Companies Act, the turnover 1 crore, 100 crore or more of the company, they can round off to the nearest lakhs, millions or crores or decimals thereof. Intra-firm comparison means comparison within the organization among different departments and divisions. Inter-firm comparison is it is a comparison of one firm with other firm or firms in the industry. Examples of horizontal analysis is comparative statement and trend percentages. Vertical analysis is common size statements and computation of ratios. Next, ninth lesson. The time between the acquisition of an asset for processing and its realization into cash and cash equivalent is operating cycle. These assets cannot be converted. Inventories and prepaid expenses cannot be converted into cash. So only the benefit can be derived. So it is thus excluded from liquid assets. Normally 2:1 is considered as the ideal current ratio. Normally 1:1 is considered as ideal quick ratio. In general, a debt equity ratio 1:1 may be considered satisfactory. Shareholders fund can also be computed by following this formula. Shareholders fund is equal to total assets minus non-current liabilities minus current liabilities. Debit balance in the statement of profit and loss is shown as the negative figure under the head reserves and surplus. In general, lower the debt equity ratio, lower the risk to the long-term lenders. Higher the debt equity ratio, the risk may be high. It may be difficult for the business to meet the obligation to the outsiders. Higher the proprietary ratio, greater is the satisfaction for lenders and creditors as the firm is less dependent on the external sources of finance. When the capital gearing ratio is greater than 1, the firm is said to be high geared. A high gross profit ratio indicates the high profitability. Lesser the operating cost will have a higher margin to pay off its payment of non-operating expenses. Greater the return on investment, better is the profitability of a business. Greater the inventory turnover ratio, greater is the efficiency of movement of stock. Inventory conversion period means what? Time taken to sell the inventory. A shorter inventory conversion period indicates more efficiency in the management of inventory. Turnover ratios are called as activity ratios or efficiency ratios. Greater the trade receivable turnover ratio, greater the efficiency in managing the collection of trade receivables. Debt collection period is it indicates the average time taken to collect the amount due from the trade receivables. Lesser the debt collection period will be greater efficiency in managing the collection of cash from the trade receivables. Greater the trade payable turnover ratio will be better efficiency in managing the trade payable. Lesser the credit payment period will be a greater efficiency in managing accounts payable. Greater the fixed asset turnover ratio, better is the efficiency in utilizing the fixed assets. Fixed asset turnover ratio can also be calculated by substituting cost of revenue from operation instead of revenue from operations. Higher gross profit should be sufficiently high to provide for indirect expenses. So if gross profit is more, we can spend it for indirect expenses. Operating profit ratio will uh, is the indicator of operational efficiency. If the net profit is higher, and it indicates overall profitability of the business. Next to the last lesson, wages account comes under direct. These all you have to see because you have learned everything in the 11th standard accountancy, final accounts. You must know what are direct expenses, indirect expenses, current asset, that all they may ask. And function key F7 is journal voucher, and which of the following shortcut key is used to create new ledger is Alt plus C. Thank you students for watching. If this video is useful, kindly share with your friends.